There is a group of people in this country who can spend $100 million in a year and legally owe almost nothing in income tax, and they are not breaking a single law. The richest Americans routinely hand a smaller share of their fortunes to the tax collector than the nurse who takes care of them. They do it with a strategy so simple it fits in 3 short words: buy, borrow, die. It is not a loophole buried in the fine print, it is the plain machinery of the tax code, working exactly the way it was written to work. I am Sterling, an owl in a pinstripe suit who reads the tax code the way other birds read the weather. My whole job is keeping money plain and keeping your money yours, and today I am going to show you the quietest trick in modern finance. By the end, you will understand how a person can be worth $200 billion, live like a king, and still hand the government less than 1% of it. So keep one word in your mind the entire time: income, because the whole secret is that the very rich have almost stopped having any. Let us start with the number that shocked the country, because for a long time nobody outside the tax office could even see it. In June of 2021, a newsroom called ProPublica published something extraordinary. They had obtained years of private tax records for thousands of the wealthiest people in America. And they did something simple with those records. They compared how much tax each person paid to how much their fortune grew. They called that comparison the true tax rate, and the results did not look like anything on a normal pay stub. From 2014 to 2018, the 25 richest Americans saw their combined wealth grow by about $401 billion. Over those same years, they paid about $13.6 billion in federal income taxes. That works out to a true tax rate of roughly 3.4% on the wealth they gained. For comparison, a typical worker living on a salary can hand over a far larger slice of every single paycheck than that, and the individual names were even sharper than the group. By ProPublica's calculation, Warren Buffett, one of the richest men alive, had a true tax rate of about 0.1%. Jeff Bezos, the founder of Amazon, came out around 1%. Elon Musk landed a little over 3%. Michael Bloomberg and other household names sat down in the same low single digits. And in certain years, it got starker still, because some of these men paid nothing at all. ProPublica reported that Jeff Bezos paid $0 in federal income tax in 2011, and again in 2011. It reported that Elon Musk paid $0 in federal income tax in 2018. These are men whose fortunes were climbing by tens of billions, handing the tax collector the same amount as a person with no job at all. When the story broke, the natural assumption was that this had to be fraud, some offshore scheme, some army of clever cheats. But here's the part that makes it worth a whole video. Almost none of it was illegal. There were no secret islands doing the heavy lifting, no forged numbers, no hidden accounts at the center of it. The records largely showed people following the written rules exactly as they stand. The scandal was not that they broke the law, the scandal was that the law lets them do it. So the real question is not, how did they cheat? It is, how does the ordinary tax code make this possible? To understand the trick, you have to understand one deep fact about how America taxes money. The tax system is built to tax income, meaning money that comes in, wages, a salary, a paycheck, a freelance fee. It is very good at catching income because for most of us, income is the only money we ever really touch. But the tax code barely touches a second kind of money, the money you gain when something you already own goes up in value. If you buy one share of stock for $10 and it climbs to $1,000, you have gained $990. On paper, you are richer, but the tax office does not count that gain as income, not yet. That kind of growth has a name. It is called an unrealized gain, a profit that so far only exists on paper. And the rule around it is beautifully simple. An unrealized gain is not taxed until you sell. The tax only arrives at the moment you cash out, the moment you actually realize the gain. So now look at the first word of our trick: buy. The very wealthy hold their fortunes not as cash sitting in a bank, but as things they own, mostly company stock. Jeff Bezos never had $200 billion in a checking account. He had a mountain of Amazon shares. Elon Musk's fortune is not a pile of cash either. It is stock in Tesla and his other companies. As those shares climb, their owners grow richer by the day, and none of that growth counts as taxable income. A man can gain $50 billion in a single year this way and, on income alone, owe nothing on the gain. But this creates an obvious problem. You cannot buy a house or a yacht with stock you refuse to sell. At some point, even a billionaire needs real spendable cash, and selling the stock would finally trigger the tax. This is where the second word does its quiet work: borrow. Instead of selling the shares and paying tax, the wealthy borrow money using those very shares as collateral. Banks are delighted to do this because they will happily lend enormous sums against a large stock portfolio. These are real products with plain names: securities-backed lines of credit, portfolio loans, pledged asset lines. The billionaire pledges the stock, the bank hands over the cash, and not a single share is ever sold. And now for the piece that ties the whole knot together: a loan is not income. When a bank lends you $1 million, you have to pay it back, so the tax office does not treat it as money you earned. That means the cash a billionaire lives on, borrowed against their stock, arrives completely free of income tax. They buy the mansion, the jet, and the art with money the tax code never gets to touch. You might expect the interest on all that borrowing to ruin the plan, but the interest is often surprisingly small. The very rich borrow at very low rates because the bank knows the loan is backed by a mountain of valuable stock. So a low interest rate on a loan can be far cheaper than the tax bill that selling the stock would create. Meanwhile, the stock stays put and keeps growing, often faster than the modest interest piling up on the loan. The fortune keeps compounding, untouched and untaxed, while its owner lives on borrowed cash drawn against it. Buy assets that grow, refuse to ever sell them, and borrow to pay for your life, and you can go decades owing almost no income tax. But every plan has a weak point, and this one has a large one waiting at the very end. The loans do not vanish. They pile up year after year, and one day they have to be paid back. The obvious way to pay them is to finally sell the stock. And selling is exactly what triggers the tax you spent a lifetime avoiding. If the story ended right here, this would only be a clever way to delay the tax, not to escape it. This is where the third word arrives, and it is a grim one: die. When a person dies, their assets pass to their heirs, and here the tax code performs a small miracle for the wealthy. It is a rule known as the stepped-up basis. Normally, tax on a gain is measured from the price you originally paid, a figure called your cost basis. Buy a stock at $10, sell it at $1,000, and you are taxed on the $990 gain. But when you die, the cost basis of your assets is quietly reset to their value on the day of your death. All that lifetime of growth, the gain that was never taxed while you were alive, is simply wiped away for tax purposes. The heirs inherit the stock as if they had just bought it fresh at today's much higher price. They can then sell enough of it to pay off all those loans and owe little or no capital gains tax on the sale. The debt is cleared, the tax on a lifetime of gains disappears, and the family keeps the fortune. Buy, borrow, die, and an entire mountain of profit slides from one generation to the next, almost untouched by income tax. The name itself was coined by a law professor named Edward McCaffrey, who gave the whole strategy its blunt little title. And now for the plain money take, the part I actually want you to carry out of here. None of this is a secret loophole that a clever accountant sneaks through in the dark. It is the ordinary structure of the tax code, which taxes income heavily and taxes wealth barely at all. The rich did not learn to dodge the tax on income, they simply arranged their lives so that they almost never have income. The tax code does not hate the wealthy, it hates income, and the very rich quietly stopped having any. And here is the part that touches you, because a smaller version of this same machine is open to ordinary people too. When a homeowner borrows against their house instead of selling it, that loan is not taxed either. The same idea at a far smaller scale. The lesson is not to resent the billionaire, it is to see the deep line the tax code draws between what you earn and what you earn and what you earn. A paycheck is taxed the moment it lands, but an asset can grow for a lifetime and, handled this way, be barely taxed at all. So the practical wisdom is plain: over time try to own things that appreciate, not only to earn a wage that gets taxed the instant it arrives. Build yourself a base of assets that can grow quietly in the background, the way the wealthy do, even if you start with very little. Learn the difference between selling an asset and borrowing against it, because one invites the tax and the other, for now, does not. And watch this space closely, because lawmakers argue every year about taxing unrealized gains and about ending the stepped-up basis. The rules that make buy, borrow, die work are not laws of nature, they are choices, and choices can always be changed. For now, though, the machine runs exactly as I described, in plain daylight, written into the code for anyone patient enough to read it. The billionaires are not hiding in the shadows, they are standing in the shadows, they are standing in the sunlight, following the very same rulebook the rest of us live under. So there is your word, income, the one thing the very rich carefully arranged to almost never have. The plain money truth is this: the tax you pay depends less on how much you make and far more on what shape your money takes. If you would rather understand the machine than be quietly crushed by it, subscribe. Because I keep it plain and I keep your money yours.